Welcome back to Group Insurance Daily Pulse, your rapid-fire, data-driven digest for the industry's most critical developments. I'm Dorian, your distribution expert, ready to unpack the market shifts. And I'm Aria, your actuary, here to dissect the underlying risks, P&L implications, and regulatory tightropes. We've got a packed agenda today, Dorian, so let's cut straight to the numbers.
Absolutely, Aria. First up, a major consolidation play. Principal Financial Group is set to acquire Beam Benefits. This is a strategic move to bolster Principal's presence in the small and mid-sized business market.
$175 million in top-line premium for 25,000 small businesses points to an average premium per business of just $7,000, indicating a very small segment indeed. While the strategic intent to hit a 5-9% growth target is clear, the P&L implications here are complex. My primary concern is the integration risk. Merging distinct cloud-based AI platforms can be a costly, resource-intensive endeavor with a high potential for operational friction. We're talking about disparate data models, underwriting algorithms, and claims processing logic.
The market is clearly valuing the scalability, Aria. Beam's AI isn't just a wrapper. It's a foundational element enabling efficient servicing and pricing for a segment traditionally challenging to underwrite profitably due to high acquisition costs.
Future-proofing often translates to significant upfront investment with deferred, uncertain returns, Dorian. The diligence on the AI models themselves, their predictive accuracy, bias detection, and compliance with emerging AI governance frameworks must be exhaustive. A single misstep in an algorithm could lead to systemic underpricing, regulatory fines, or significant reputational damage. We must also consider the potential for channel conflict if Beam's direct-to-SMB approach clashes with Principal's traditional broker relationships. And what about the capital charges post-acquisition? Are we anticipating any adjustments to Principal's RBC ratio due to the goodwill generated and the operational risk associated with integrating a new tech-heavy subsidiary? The regulatory filings for such a transaction, particularly across multiple states, are non-trivial and will consume considerable actuarial and legal resources. Shifting gears to product innovation, Arch Insurance North America has significantly expanded its employee benefits portfolio. On July 8th, they launched a new suite of voluntary insurance benefits, including accident medical expense, hospital cash indemnity, and annual travel insurance. These are designed to provide flexible coverage options, help employees manage out-of-pocket medical expenses, supplement hospitalization costs, and cover travel-related risks. Crucially, Aria, policy issuance for these benefits requires no medical underwriting. No medical underwriting immediately flags a heightened risk profile, Dorian. While this simplifies distribution and enhances employee access, the actuarial pricing models for such products must incorporate a broader, less selected risk pool. The absence of underwriting implies a higher likelihood of adverse selection, particularly for hospital cash indemnity, where individuals with pre-existing conditions or anticipated medical events might disproportionately enroll. My concern is the initial loss ratio trajectory and how Arch plans to manage the claims experience. Are they leveraging historical claims data from similar no-underwriting products in other markets? Or are they relying on population-level morbidity assumptions, which may not hold true for self-selecting groups? What's the maximum benefit duration for hospital indemnity? What are the exclusion clauses for pre-existing conditions if no medical underwriting is performed? This will be critical for managing overall P&L. From a reserving perspective, the stochastic nature of these claims, particularly for accident and hospital indemnity, requires robust IBNR calculations, and any underestimation could rapidly erode surplus.
Aria, the strategic intent here is clear. Market demand for flexible, portable benefits is surging. Employers are seeking ways to enhance their benefits package without directly impacting their bottom line, and employees want tailored protection against rising out-of-pocket costs. No medical underwriting is a key differentiator, reducing friction in enrollment and increasing participation rates. This isn't about ignoring risk. It's about leveraging broader demographic data and sophisticated pricing algorithms that factor in group size, industry, and participation levels, rather than individual health status. For brokers, this is an invaluable tool to fill critical coverage gaps, especially for clients struggling with high-deductible health plans. The ease of issuance directly translates to higher close rates and improved client satisfaction.
Diversification is commendable, Dorian, but not at the expense of sound actuarial principles. The pricing must adequately reflect the inherent risk of a non-underwritten block. We need to see the projected MLR for these new lines. Are the premiums loaded sufficiently to cover higher anticipated claim costs, distribution expenses, and a reasonable profit margin while remaining competitive? What's the re-rate mechanism for these products? Without individual health data, rate adjustments will need to be based on group-level experience and broad population health trends, which can be slower to react to emerging claim patterns. Furthermore, the regulatory scrutiny on no medical underwriting products is intensifying, particularly concerning transparency around exclusions and benefit triggers. Arch must ensure full compliance with state-specific consumer protection laws and avoid any potential for misrepresentation. The operational overhead for claims processing, particularly for travel insurance, also needs to be meticulously costed to avoid eroding profit margins. This isn't just about selling policies, it's about paying claims sustainably.
Moving into the specialty insurance space, Aero Global Group announced its acquisition of Fusion Specialty Group on July 9th. Fusion is a specialist managing general agent, or MGA, and it's been a powerhouse. Since its launch, it has processed over 23,000 submissions and written approximately £290 million GBP in gross written premium, with its premium volume more than doubling over the past 2 years. This acquisition is expected to close in Q3 2026, pending regulatory approvals. This clearly signals a strategic focus on acquiring niche expertise and efficient distribution models.
An MGA acquisition, particularly one with such rapid growth, immediately raises flags regarding delegated authority and underwriting oversight. £290 million in GWP is substantial for an MGA, and the doubling of premium volume in 2 years, while impressive from a top-line perspective, demands rigorous scrutiny of the underlying risk selection and pricing integrity. My primary concern here is the potential for premium leakage and the alignment of Fusion's underwriting philosophy with Aero Global's risk appetite and capital structure. Who ultimately holds the risk? Is Fusion fronted by a carrier? And if so, what are the terms of the quota share or excess of loss reinsurance treaties in place? The actuarial review of Fusion's reserving practices, particularly for IBNR, is paramount. MGAs, by their nature, operate with a degree of autonomy, and ensuring their claims estimates are robust and align with the ultimate risk-bearer standards is critical for solvency. Furthermore, regulatory bodies, especially the DOI, are increasingly scrutinizing MGA compensation structures and their potential influence on underwriting decisions.
Aria, this isn't just about volume. It's about specialized expertise and market access in segments that are often underserved by traditional carriers. Fusion's 23,000 submissions indicate a highly efficient distribution pipeline and deep broker relationships within specific niche markets. The value proposition for Aero Global is acquiring that proven underwriting talent and market penetration without the significant build-out costs. MGAs like Fusion are agile, customer-centric, and often possess proprietary data and analytical capabilities tailored to their specific risks, leading to better pricing accuracy within their defined segments. For brokers, this consolidation often means expanded access to a wider range of specialized products under a strengthened, more capital-backed platform.
While the appeal of niche expertise is undeniable, Dorian, the due diligence on Fusion's historical loss ratios and their variance must be incredibly thorough. Rapid growth in GWP can sometimes mask underlying issues if the claims experience hasn't fully matured. What's the average policy duration for these specialty lines? Are there long-tail liabilities that could emerge years down the line? We need to understand the capital allocation implications for Aero Global. Is this acquisition immediately accretive to earnings, or is there a period of integration and re-underwriting that will impact P&L? And again, the regulatory landscape for MGAs is evolving. Ensuring compliance with state-specific licensing requirements, producer compensation rules, and data privacy regulations is a significant undertaking. The risk of E&O claims arising from delegated underwriting authority is also a material consideration that must be quantified and reserved for. This isn't just about integrating a business, it's about integrating a risk-taking entity and ensuring its continued solvency and regulatory adherence. A 20% deviation from age-neutral rates is a significant actuarial lever, Dorian, and immediately raises concerns about potential market fragmentation and adverse selection within these newly formed pools. While the intent to enhance affordability for small businesses is clear, we must consider the broader implications for the existing ACA risk pools. If healthier small groups migrate to these new, potentially cheaper pooled options, it could leave the ACA marketplace with a sicker, more expensive risk profile, driving up premiums for those remaining. This is a classic example of potential death spiral dynamics if not carefully managed. My primary concerns are, what are the actuarial guidelines for rate adjustment? How will the DFR ensure solvency within these pools, particularly if they are self-funded or partially self-funded? Will ERISA preemption issues arise if these pools are deemed to be multiple employer welfare arrangements, MIWAs? The regulatory oversight for MIWAs is complex and varied by state, and ensuring compliance will be critical. Carriers will need to develop entirely new pricing models and product structures to capitalize on this flexibility, requiring significant actuarial resources and DOI approval for new rate filings. The potential for inconsistent pricing across similar demographics, driven by this 20% variance, could also invite regulatory scrutiny and consumer confusion.
Aria, this executive order is a direct response to the escalating healthcare costs burdening Vermont's small businesses. The ability to form pools and leverage alternative options beyond the ACA provides a much-needed mechanism for cost control and greater plan design flexibility. The 20% rate adjustment allows carriers to price more accurately for specific group demographics, rewarding healthier groups with lower premiums, which is a powerful incentive for employers and employees. This isn't about fragmenting the market, it's about creating choice and competition, ultimately benefiting the consumer.
Empowering small businesses should not come at the cost of actuarial stability or regulatory coherence, Dorian. The DFR's ability to allow a plus or minus 20% adjustment from age-neutral rates necessitates precise actuarial justification. Are these adjustments based on actual group experience or broader demographic factors? What mechanisms are in place to prevent cherry-picking of healthy groups, leaving less healthy groups in higher-cost segments? The risk of an unlevel playing field for carriers operating both within and outside these new frameworks is significant. Furthermore, the administrative burden for carriers to manage these new pooling arrangements, develop compliant products, and navigate potential ERISA ambiguities related to MIWAs or Association Health Plans, AHPs, cannot be underestimated. Solvency is paramount, and any relaxation of underwriting or rating rules must be accompanied by robust oversight to prevent market instability. The P&L impact on carriers will depend entirely on our ability to price these new products accurately and manage the claims experience within these new, potentially volatile pools.
And finally, a forecast that will impact every corner of the group insurance market. KFF predicts a median 14% ACA premium hike for 2027. This analysis, based on 2027 filings from 16 states, forecast increases ranging from 7% in Vermont to a staggering 25% in Indiana. The primary drivers are escalating healthcare costs, increased labor expenses, the rising cost of GLP-1 drugs, more complex medical cases, and general inflation. This follows dramatic 2026 rate hikes and the expiration of enhanced ACA marketplace subsidies, with KFF also noting that approximately 5 million people were expected to drop or lose ACA insurance before the end of 2026. This is a significant cost pressure for employers.
A median 14% hike following dramatic 2026 rate hikes signals an accelerating and unsustainable medical trend, Dorian. This isn't just an ACA marketplace issue. These underlying cost drivers, escalating healthcare services, labor, GLP-1s, and complex cases, will invariably propagate through the entire employer-sponsored group insurance market. For carriers, this translates directly to immense pressure on medical loss ratios, or MLRs, and necessitates aggressive pricing adjustments for 2027 renewals. My immediate concerns are, how are carriers factoring in the exponential growth of GLP-1 drug costs, which can average $1,000 to $1,300 per month per patient, into their trend assumptions? Are they adequately reserving for the long-term implications of these treatments, not just the drug cost, but also potential downstream effects? The 7% to 25% range highlights the uneven impact of these drivers across states, necessitating granular, state-specific trend analyses.
Aria, this KFF forecast underscores the critical need for employers to strategically reevaluate their benefits packages. While the cost pressures are undeniable, they also create opportunities for innovative solutions. Brokers must be prepared to advise clients on a holistic approach, exploring self-funded options, implementing robust wellness programs with measurable ROI, optimizing pharmacy benefit management, and leveraging voluntary benefits to offset increased employee cost sharing.
Mitigation is key, Dorian, but the scale of these increases requires more than incremental adjustments. We're talking about fundamental shifts in actuarial assumptions and risk management. Carriers must review their reinsurance treaties for adequate coverage against catastrophic claims, particularly those driven by high-cost specialty drugs. The capital implications of managing such volatile medical trend are significant. Higher premiums mean higher reserves, which ties up more capital. The regulatory environment will be intense, with DOIs demanding exhaustive justification for rate increases, potentially leading to rate compression and further pressure on MLRs. The long-term P&L implications are severe if carriers cannot effectively manage this trend. This isn't just about market share. It's about the sustainability of the group health insurance model itself under these cost pressures. Every carrier's solvency will be tested.
And that brings us to another packed Group Insurance Daily Pulse. Aria, always a pleasure to dissect the numbers with you.
Indeed, Dorian. The market is dynamic, but the underlying actuarial principles and regulatory demands remain constant. We'll be watching these developments closely, particularly the integration complexities for Principal, the risk management for Arch's no UW products, the MGA oversight for Arrow, the market implications of Vermont's pooling, and the solvency pressures from the KFF's ACA hike forecast.
Absolutely. For more in-depth analysis, join us next time on Group Insurance Daily Pulse. Until then, stay informed, stay strategic.